Well, is it or isn't it recovering? The U.S. housing market has been throwing us head fakes right and left lately. 1 minute, new home sales look absolutely awful. The next, we get housing starts that surged in April to, I pretty much believe, their highest level in 6 years. Then you throw in all kinds of other indicators like what we just talked about, rising rates, low inventories. That neutralizes some of the good, some of the bad news. Yeah, we're setting you up for a vicious bull-bear debate with more. I'm joined by our bear, Peter Schiff, Euro Pacific Capital CEO, coming to us from Weston, Connecticut, and our bull, Barry Habib, MBS Highway founder and CEO. Gentlemen, welcome. Barry, you've made an entire living buying, selling, helping with mortgages. Where do you see the housing world right now?
The housing world, in my opinion, is continuing to do pretty good. It's not great, but that's almost a good thing because you don't want to be too far ahead of itself. I think 5 to 6% appreciation is very healthy, and I think that's about where we are right now. Low inventories is a big driver of support for prices and appreciation. Although housing is not really contributing to GDP and growth, there's a big difference there between housing as it contributes to the economy and housing the investment.
Yeah, because you have a lot of hedge funds snapping up 38 houses in tranches or sometimes even more out in Detroit. But Peter, okay, your assessment. Is the housing market rebuilding? Is it in trouble? Is it near death?
Well, it's another bubble. You know, the Federal Reserve inflated the first housing bubble, and when it burst and we had the financial crisis, their solution was to try to blow it back up again. But there's a big difference between the bubble they've created this time and the last one. The last bubble was a Main Street bubble. Individuals were buying up houses, flipping houses, remodeling, extracting their equity out of their houses, spending it, and so you had all this phony GDP that resulted from the last housing bubble. This time around, it's different. This is a Wall Street bubble. The average American is too broke to buy a house. Home ownership rates are at 19-year lows. Most Americans are renting. That's why the housing numbers that you just mentioned for April, all the construction was in multifamily, was in apartments. So Americans are renting. Meanwhile, thanks to the Fed, rents are rising, food prices are rising, utility prices are rising, along with the cost of everything else. And so there is no wealth effect. You just have these private equity guys gobbling up single-family homes that average Americans are too broke to buy. And the hedge funds think that they can rent these houses out. Well, they're just figuring out that most Americans are also too broke to rent them, which is why most of these houses are sitting vacant or they're being rented at rates much lower than what the buyers thought. I think eventually a lot of these houses that the private equity guys have are going to be sold. They're going to come on the market, and the prices will have to fall precipitously before real buyers can afford them.
Okay, that's the free market, though,
Peter,
isn't it?
There's three things I want to point out, just statistically speaking. You bring up some good points, but statistically speaking, first on vacancies. 12.4 million vacancies. That is less than what the 133 million housing units normally would have. So we are actually in a situation where there is less vacancies than historical norms. In addition to that, you mentioned that when we see a lot of renters out there. That's actually a good thing. When we had 70% home ownership and 30% renters, that was bubble territory. Today, at 65% home ownership and 35% renters, it gives us a crop of renters to choose from. And the biggest point, though, is that, hold on, let me fill in. The biggest point here, Peter, hold on. The biggest point is that when you have a bubble like you had mentioned, today is very different because back then mortgages were in a position where they were not very strong. They were given a lot of mortgages out at crazy negative amortization type of deals. We didn't have equity buildup. Today's mortgages are performing stronger than ever. The crop and the vintages today provide for a very strong housing market in the future.
No, again, Barry, just like, you weren't able to figure out we had a bubble last time around until after it popped. So this is a different type of bubble. As I said, this is a bubble on Wall Street. And a lot of these houses, 40–50% of homes being bought all cash.
So let them
this
make
money
their
is actually
mistake,
not
Peter.
cash.
Let
it's being
Wall
borrowed by hedge funds.
Let them make their bad rules. I doubt they're going to get bailed out a second time.
No, but they're gonna take losses on these homes. They're gonna have to bail out of this trade and cut their losses.
Well,
but the problem is when all the speculators who have been buying try to unload these homes, there are no buyers. Most Americans are broke. They're loaded up with student loans, auto loans, credit card debt, and they're barely making any money. A lot of Americans have lost their jobs along with their homes, and they're working part-time. They got a minimum wage job if they're lucky. How are they going to buy a house? A lot of people are still living with their parents.
Doesn't that make it more affordable if they have to be discounted, Barry?
Absolutely it is. And affordability levels are much better than they have been by historical measures. They're not as good as they were in 2013 and 2012. Yes, we agree on that because prices have gone up and because we see interest rates have gone up. But interest rates appear to be headed lower. Even if they aren't, the levels that there are still very, very affordable. And by the way, we did get it right here with Liz on when the market was turning to the upside, and we did get it right to the downside right here with Liz.
Well, you called the bottom in 2011, but Peter called the subprime implosion way back in 95. So, I mean, 2005, right, Peter?
You know, wait till interest rates rise and the Federal Reserve isn't buying up all these mortgages. Wait till mortgage credit becomes even tighter than it is now.
And at this rate,
we're headed back into recession. Q1 wasn't the weather.
After QE1 and QE2, rates went down. After tapering, rates have come down.
All right, we got to go. On that note, Barry
because
Habib,
they're going to untaper. The market is anticipating the next round. Because the economy is going back into recession.
Peter. Okay, you guys can argue over the phone.
Go switch to the decaf.